If you follow the standard Wall Street consensus, Tesla is an automaker in deep trouble. Analysts point to missed delivery targets and slowing demand as proof that the company is losing its edge. But the financial data from their 2025 fiscal year reveals a much more complex reality. This chart shows Tesla's automotive revenue trend. In 2025, that top-line number contracted by 10% year-over-year, dropping to $69.5 billion. Operating margins took an even harder hit. They compressed by 265 basis points, leaving the core manufacturing business with a razor-thin 4.6% margin. Yet, sitting right beneath that hardware contraction is a glaring paradox. Despite the declining vehicle sales, the company generated $14.7 billion in operating cash flow. Looking at the ultimate liquidity metric, free cash flow actually surged 74% to $6.2 billion. That pushed their total cash and investments pool to a record $44.1 billion. A heavy manufacturing enterprise experiencing a cyclical decline in its core product does not normally stockpile cash at this rate. To understand where this liquidity is coming from, we have to look at the mechanics of their legacy business. Tesla operates some of the largest automotive manufacturing footprints on the planet. Maintaining these massive industrial complexes requires an enormous amount of overhead capital. In 2025, total vehicle deliveries fell 9%, landing at 1.63 million units globally. This graphic visualizes a concept called fixed cost absorption. When a factory has rigid operating expenses but produces fewer cars, the cost to build each individual unit mathematically inflates. That mathematical penalty is being heavily compounded right now by an increase in global trade tariffs, putting an aggressive squeeze on the final margins. This volume drop is largely a symptom of product maturity. The Model 3 and Model Y are older platforms, and demand naturally cools as a vehicle lifecycle extends. The traditional, volume-based automotive scale model has hit a cyclical trough. To survive this compression, the enterprise is being forced to execute a structural pivot. That pivot relies heavily on the energy generation and storage segment, which is rapidly transitioning from a secondary project into a primary financial engine. This waterfall chart shows shrinking auto gross profits being offset by the countercyclical growth of the energy division. Physical deployment surged 49% year-over-year, hitting 46.7 gigawatt-hours. At that scale, the financial return is immense. In the fourth quarter alone, the energy segment delivered a record $1.1 billion in gross profit. These returns are driven by massive utility-scale installations, specifically the deployment of commercial Megapack infrastructure. Utility-scale energy storage is effectively acting as a high-margin financial bridge, providing the cash flow needed to fund the company's broader transition. The second structural pillar supporting this margin offset is the services and other segment. This pie chart illustrates total revenues. Over the last year, the services and other wedge expanded by 19%, reaching $12.5 billion. More importantly, the internal mechanics of this segment are shifting. The company is actively moving away from one-time software purchases toward a recurring monthly subscription model. That strategy is accelerating adoption. Active subscriptions for full self-driving software surged 38%, bringing the total to 1.1 million users. Every time a driver engages this autonomous software on their touchscreen, they pay a monthly fee and feed real-world driving data back to the company. The services segment takes a base of one-time hardware buyers and successfully converts them into a high-margin, recurring software revenue stream. Every dollar generated by energy and software is being immediately redirected. It is flowing directly into a proprietary North American AI training infrastructure. This flowchart tracks the $8.5 billion in capital expenditures for 2025. You can see capital diverted away from traditional auto manufacturing and pouring straight into AI compute. That capital is sinking primarily into two massive data clusters, Cortex-1 and Cortex-2, to double on-site compute capacity. Housing that level of on-premise training hardware requires an industrial footprint of staggering scale. Tesla is using the cash flow from its legacy automotive business to construct one of the most capital-intensive physical AI training infrastructures on Earth. But building massive data centers is only half the equation. The other half requires engineering at the microscopic level. This graphic breaks down specifications for their in-house AI5 inference chip, scheduled for production in 2027. By utilizing hardened block quantization, the chip allows for efficient, low-precision computing, driving a 50x performance improvement over their AI4 hardware without sacrificing model accuracy. To complement this custom silicon, the company executed a $2 billion strategic investment into xAI. Under Master Plan Part 4, xAI's large language models, like Grok, provide the foundational intelligence required to bring digital AI services into the physical world. By designing the bespoke silicon and taking a heavy stake in the foundation models, they are assembling a vertically integrated AI stack that traditional legacy automakers simply do not have the capacity to replicate. All of that silicon and server capacity is already translating into commercial reality on the streets of Austin. In January, the company hit a critical operational milestone by removing safety monitors from their robotaxis, allowing unsupervised customer rides. This map shows their immediate expansion plan, targeting commercial rollouts across major Sunbelt metros like Dallas, Phoenix, Miami, and Las Vegas by the first half of 2026. At the same time, dedicated physical hardware like the Cybercab is already undergoing production tooling and extreme cold weather testing. The deployment of an unsupervised robotaxi fleet is the ultimate financial proof of concept. It justifies the billions of dollars currently being poured into compute clusters and chip design. This brings us back to the initial paradox: declining automotive deliveries stacked against record corporate liquidity. Tesla is repositioning itself as a digital intelligence network that uses physical hardware to interact with the world. New physical forms, like the Optimus humanoid robot, serve as the next hardware nodes designed to plug into this overarching intelligence network. This chart illustrates the endgame. Hardware-related manufacturing is being engineered to serve as a low-margin delivery system for high-margin AI software. Wall Street's focus on quarterly unit delivery volume overlooks the primary takeaway of the 2025 financials. The balance sheet reveals a fundamental shift. Tesla is aggressively reallocating its automotive capital to build the infrastructure of a physical AI enterprise.